All right, let's get right into it. I want you to picture the early 2000s. The economy felt like it was on an unstoppable rocket ship, and for millions of people, the American dream, owning your own home, it felt closer and more real than ever before.
And the housing market, it was absolutely on fire. I mean, not just busy, it was frantic. Homes were getting snapped up at a crazy pace, and bidding wars became totally normal in neighborhoods all across the country.
We're not talking about small little bumps either. We're talking huge, double-digit leaps in value, year after year. Your house wasn't just where you lived, it was an investment that literally felt like it could not lose.
Now, this entire frenzy, from the first-time buyer to the most powerful banker on Wall Street, it was all built on one single, universally held belief, an idea that felt as solid and as real as the law of gravity.
And this, right here, is the absolute core of the story. This wasn't just some optimistic phrase, it was treated like a fundamental law of finance. Because hey, if prices only ever go up, then lending money for a house isn't risky at all, right? This one simple yet completely wrong assumption, well, it set the stage for a global catastrophe.
So how in the world did that one idea lead to a complete global meltdown? To get that, we've got to look under the hood at the financial machinery that was humming along right on top of it.
Okay, so it all started here. To keep this boom roaring, banks started giving out loans to pretty much anyone who asked, oftentimes without even really checking if they could pay it back. These were called subprime mortgages, and they were designed for the riskiest borrowers. But see, the banks didn't really care, because they had a clever plan to get that risk off their own balance sheets.
And here's where the financial magic, or maybe I should say mischief, comes in. The banks took thousands of these really risky mortgages, chopped them up, bundled them all together into something called a mortgage-backed security, or MBS, and then sold these packages off to investors all over the world. Now, the truly insane part, ratings agencies, the very people meant to be the referees, stamped many of these bundles with a AAA rating. That's the safest rating you can get. They were basically selling ticking time bombs and calling them solid gold.
So just imagine millions of incredibly risky loans, all diced up and hidden inside investments that were labeled perfectly safe. They were everywhere, in pension funds, college endowments, investment banks. Nobody really knew exactly where all the rotten pieces were, but they were there, ticking away deep inside the system.
And then the ticking stopped. It started in 2006, when interest rates began to creep up. Suddenly, those easy monthly payments weren't so easy anymore. By 2007, people were defaulting on their loans left and right. With all those foreclosed homes flooding the market, that core belief, housing prices never fall, it didn't just crack, it shattered. And those safe investments, they became worthless overnight. The panic finally boiled over in September 2008, when the giant investment bank Lehman Brothers went bankrupt. That was it. The entire global system just froze.
The damage was just staggering. Over $10 trillion in wealth just poof, vanished. And remember, that's not just a number on a spreadsheet. That's people's retirements, their kids' college funds, their small businesses, their life savings, all gone. But the numbers and all the confusing financial terms, they don't really tell the whole story. To truly understand what happened, we have to look past the spreadsheets and look right into human nature itself.
And here's the real insight. Those complicated financial products, they were just a weapon. The real cause of the crisis was something much more basic, something much more human. It was about us, how we think, how we behave in crowds, and especially how we act when there's the promise of easy money on the table.
So let's break down those human drivers. You had pure greed, of course, but you also had this massive wave of overconfidence, this belief that we had somehow figured it all out and solved risk. Then there was herd mentality, right? Everyone just following each other, assuming the crowd knew where it was going. And holding it all together was that one incredibly dangerous thought, the story we tell ourselves in every single bubble. This time is different.
And that brings us to the most uncomfortable, but also the most important part of this entire discussion. We've looked at what happened back then, but what about now? This is the question we absolutely have to ask ourselves. Because while the specific investments might look different today, it's maybe not subprime mortgages, the human behaviors, they are timeless. History doesn't repeat itself perfectly, no, but human psychology, you can bet on that repeating again and again.
I mean, just look at the parallels. We see markets hitting all-time highs, often fueled by enormous amounts of debt. We see wild speculation in all sorts of new and exciting assets. And maybe most telling, we see this widespread feeling that risk is a thing of the past, that things can only keep going up. Does any of that sound just a little bit familiar?
The pattern is just undeniable. Back then, it was risky mortgages. Today, it's speculation in other areas. The old mantra, housing never falls, has just been swapped out for the classic, this time is different. That blind faith people had in complex products is now mirrored by this intense fear of missing out, what we all call FOMO. And just like in 2007, the people waving caution flags are mostly being ignored. The psychology is almost a perfect match.
Okay, so if these historical patterns are popping up again, the big question is, what can you actually do about it? This isn't about trying to predict the future with a crystal ball. It's about being prepared for it.
So here's a really simple playbook. Rule number 1, and it's the most important, don't panic. Fear and greed are the absolute worst financial advisors. Rule 2, don't chase the hype. When it seems like everyone is stampeding into one thing, that is usually a time for caution, not for jumping in. And rule number 3 is just prepare. Honestly, just by understanding that these cycles exist, you are already way ahead of the curve. Your awareness is your power.
And this is how that awareness turns into action. Smart, long-term investors study history. They don't pretend risk doesn't exist, they respect it. They don't throw all their money at one hot idea. They think in terms of years and decades, not days and weeks, and they know a crucial secret. While market crashes are painful, they also act as a reset and can create incredible opportunities, but only for those who are prepared and not panic.
And really, that's what this all comes down to. The story of 2008 isn't meant to scare you. It's a powerful lesson that, frankly, most people have already forgotten. But if you remember it, if you really understand the timeless patterns of human behavior that drive these boom and bust cycles, then you don't have to be afraid of what comes next. You can be ready for it.